Good morning, everyone. Welcome to this update for global stocks and commodities for the 21st of January. And global markets just keep doing what they've been doing since the start of the year. And as you'll see from the charts, we're getting quite a lot of deviation to the upside. But at the moment, all you can say is that the market strength is still there. There's no real signs of weakness, and the trend is up. So let's jump in and have a look at the agenda for this video. I'm just going to pose the question, are there any signs of weakness? So I'm going to go on a bit of a hunt for that. I'm getting questions from a number of members and also a few non-members about whether they should be taking profits or not. And so that's a really interesting question. The normal stock and commodity trend update, and for those that aren't that haven't had a look at Portfolio Analyst, there's a free 2-week trial which is available. And last week we covered what I think is probably the most valuable technical skill that one can develop, and that's just identifying where the absolute sweet spot for entry is. Where is the point where the potential reward is greatest and the potential risk to the downside is the least? And it's actually quite a straightforward process once you get your mind around the way that the market actually works. There was also a couple of speculative buys that were in response to member questions. There was some of the best opportunities in the US energy sector presented. So it was a pretty good session last week. And if you joined up for the free trial, then you'd be able to take all that in. Now let's look at American stocks. The S&P index up by another 24 points on the week, and the market has gone up so hard now for such an extended period that there just had to be some evidence of some buyer exhaustion, because buyers just can't keep stepping up to the plate week after week after week. And so enter Tuesday, the first day of the new week in America after the public holiday. And there was a sharp sell-off. The market initially up quite significantly in the morning, and then sold off very sharply in the afternoon. And with the market so elevated, that of course posed a question about whether this would be some sort of retracement. But once again, it lasted just one day, and the markets took off again, as you'll see. Now, corporate earnings season started a little bit over a week ago, and corporate earnings are coming through very nicely. It's only a relatively small sample, but nearly 70% of reports are beating estimates on the profit line, and it's been a very good start, particularly by the US banks. And a healthy market is characterized by strength in financials and strength in the NASDAQ. And we've certainly got that in spades in America at the moment. Now, it's an added bonus through the week, in addition to the synchronized global growth that we've got, expansion in Europe. So things are looking good there. Things are looking much better in Japan. Chinese GDP came in above expectations at 6.9%, which was the first expansion in GDP in quite a number of years. So that was a real positive. And despite what you might read in the media, the Chinese seem to be doing a very, very good job of managing this transition from an export economy to a consumer-driven economy. And everyone expected a few bumps along the way, but so far they've done a pretty good job. Now, sentiment has turned bullish this year. We've gone from disbelief and doubt since 2009. I think we've finally reached a bit of mild bullishness. But for that to become a problem and lead to an eventual market top, that bullish sentiment needs to stay there for a long period of time to be an issue. So this is just very early stages. Now, the US dollar showed a slight recovery, but it was very oversold, so that was expected. And really, it's last week I said it was a bit of a head scratcher, but this is really more of a euro strength story. The euro being stronger than the US dollar, because of relative perceived growth rates. But I think that story is perhaps overdone now. The euro is overbought, the US dollar is oversold, so it wouldn't surprise to see a short-term reversal there. Let's jump in and look at some charts. We'll start with the S&P, and you can see this was Tuesday, so we gapped up on the open and then traded down throughout the session and ended up down for the first time since the 2nd of January. Now you can just see how far the index has deviated from the blue 50-day moving average line to the upside. And when I pan back, it's actually challenging to find a time when the market is that far above both the blue line and the red line. So the 50-day moving average and the 200-day moving average. So here I've gone all the way back to, this is 2000, so there's 18 years worth of history. And I can't find another occasion when the market is as extended as far above the moving averages as it is right now. Now, that's not a reason to be getting out of the market. As you know, my view is that you take your cues from what the market is telling you. You stay with the trend until the trend shows you otherwise, and that advice is still the same. However, there are some things that you should be doing at the moment, and that's taking greater care with your entries, because the odds of this market going through a bit of a pullback are obviously now higher than they were when the index is let's say, down here, as it was in mid-November, being close to the 50-day moving average. So the odds of a reversal far, far higher up here. So you want to take greater care with entries. You want to insist on a dip, and whilst the overall S&P index has continued to rise, we are seeing periodic dips in individual sectors and industry groups and stocks, and that's where the opportunities are lying. And what I do is have a very, very large watch list of stocks. In America, probably something approaching 500 stocks that I'm tracking on a daily basis. And if you've got such a large watch list of stocks that are already pre-qualified in terms of their fundamentals, then it's much easier to wait for the dips and to only buy under advantageous circumstances. It's harder when you've only got 4 or 5 or 10 stocks that you're watching, because you might have to wait a very long period of time. So that's one of the keys, I think, to success in this market, is just having a big enough watch list that you can be really choosy about what you go into. So what might happen from here? Well, I've just identified 2 periods here. Now the index was not as elevated as it was. I'll just take these little blocks off here. The index here wasn't as elevated above the 50-day as it is at the moment, but it was still relatively elevated. And in this case, it just went sideways from the 25th of July 2016, went sideways for about 3 or 4 months, had a little dip at the end, and then quickly recovered. So that whole period lasted about 4 months. The next period here, again, we had a deviation to the upside, and again, it just really went sideways, slightly down. Basically, it was more of the fact that the 50-day moving average caught up to the price action. I don't know what's going to happen this time because we're in uncharted waters, whether we're going to get a bit of a sharp pullback. But at the moment, we're just not seeing any real volatility. And you normally see volatility around peaks, and we're just not seeing that volatility. The daily ranges are not getting really extended. You know, look at the daily ranges here and here and here. So it's from top to bottom. And then you look here. Okay, we had a little bit of an extension on Tuesday, but the rest of the daily ranges are really modest. We're just not seeing that volatility that normally marks a top. So from my perspective, should you be taking some profits here? Look, maybe trimming a little bit, but I think this is a golden period that we're in at the moment, and you want to exploit it. I'd be very, very careful about new buys, that's for sure, and only doing it on a dip. But you know, stepping out of this market just because it's elevated, I don't believe is the right thing to do. Let's just look quickly at the other indices. The Nasdaq You can see here we had a trend channel that looked like that, and then we got an acceleration of the uptrend, which is then marked by this trend line here, and now we seem to be getting an even greater acceleration to the upside. Now this has to break at some point in time, but there's no question this is one very powerful market at the moment. Let's look at the small caps, the Russell 2000. And after we got this breakout after an extended period that occurred in September, the Russell has continued to push on. It was 144 on the index in late September. We're now at 158. So this is very broad-based in America, that's for sure. Let's just go to Europe, have a look at the DAX, and the DAX index continues to push higher as well. So we're in new territory up here in the DAX. We've got no overhead resistance, and it's moved quite strongly since the middle of 2016. This is the DAX on a weekly chart, by the way. So over the last 18 months, the DAX has moved from around 9,500 to 13,500, and that's about a 40% move. That's big for an overall index. Just look quickly at the UK market. This is the FTSE. We've also broken out on the FTSE market as well. All-time highs. Had a little bit of a consolidation here. This is a daily chart. We had a consolidation here through 2017, but we've broken out quite robustly just of late. So a lot of strength throughout. And just looking at the VIX index, we've had a little bit of a spike this week, as you can see. We did spike up on Tuesday, but we still remain at extremely low levels, around the 10 mark on the VXO. So we're close to the bottom. So there's just no signs of a top, no matter how you look at the market at the moment. Turning now to the US dollar. So we've got a couple of key levels here. We've got support, this declining support line, which you can see the dollar bounced off perfectly in the last few days. And then we've also got an important support level here, just under 90, which picks up some old highs as well. We're well oversold on the US dollar, and the way that their interest rates are likely to be rising, it's really hard to see from a fundamental point of view this trend continuing to the downside. The only reason that we're here is because of the perceptions around what's happening in Europe, and I'm not sure that the market's really got those right. It's hard to see that Europe is going to be stronger than America is, given the tax reform, the repatriation of just hundreds of billions of dollars. Apple has announced that they're going to be bringing back most of their $250 billion of overseas money. They're going to be investing many tens of billions of dollars in new facilities and hiring new staff. The stimulatory effect on America is going to be very, very substantial. And Apple's not the only one. There's a whole list of companies in America that are following suit. And whether you like Donald Trump or not, and most people don't, you've got to acknowledge that he's done something that no one else has been able to do in America for many, many decades. And it's going to have a hugely positive benefit for the American economy. Just while I'm here, let's look at the Australian dollar. So the Australian dollar got down to 75 in early December, and in the space of about 5 weeks, we've gone from 75 to 80, an enormous strength. Just while I'm here, we'll have a look at the Aussie dollar, the Aussie index. And despite all that strength overseas, we are back retesting the breakout, and it's possible that this could prove to be a false breakout because it's hard to see our banks going anywhere. So I wouldn't be surprised. That really is very, very disappointing given what we've just seen with the other indices around the world. Quite possible we could pull back in the range. If we close below 6,000, there could be a technical reaction to that and more selling in the Australian market. So very disappointing. So the Aussie dollar up at 80, and our index lost 64 points on the week. Say no more. Precious metals, gold was down by $6. That was really just the currency, the US dollar strengthening slightly. So we're down to 13.30. Precious metal stocks, I've been talking about this over the last few weeks, the fact that precious metal stocks were not leading gold higher, and that therefore I very much doubted the sustainability of that rally. And the lack of momentum has come home to roost, and we saw a turn down in the sector and in the stocks last week. So let's just take a look at those things. There's gold on a daily basis, so just easing back a little bit. And if we take a wider view on the weekly basis, we're still in a rising triangle, but we've got to break above 1380 to 1400 to get any sort of momentum, I think, and make traders sit up and take note. And if we look at GDX, we're still not seeing anything. Again, a rising triangle, but there's no real momentum there at all. You could also just say that, well, this is just going sideways. The price is slightly above the moving average, but it's not really progressing at all. Looking at other commodities, copper was down slightly to $3.18. Again, that's just currency. I normally don't comment on other resources, but a comment is worthy on the lithium price. One of the 2 or 3 biggest lithium producers in the world, SQM, which is based in Chile, has just resolved a long-running dispute with the government that's going to allow them to increase their production by 4-fold. So there's a large spike in supply is going to start happening right now. So there was an initial poor reaction to that. I'm not aware of any reaction in the actual lithium price yet, but certainly there was a sell-off in lithium stocks, both large and small, around the world. And I know that a lot of people have been playing this. I know through portfolio analysts that I get a lot of questions about Aussie speculative lithium stocks. And, I just say to you, just be really careful at the moment. I'm going to show you a few charts of what the reaction was. And if you look at the fundamentals of these stocks, most of them aren't making any money right now. Some of them will become profitable this year. But will become profitable on enormous PE ratios. Now, okay, those PE ratios will come down in 2019, 2020 if the lithium price holds up. But what if this quadrupling of supply from SQM, what if that has a material impact on the lithium price with all of the other new supply coming to market? Those PE ratios are going to blow out, and these stock prices are going to come back, and some of them are going to come back savagely because some of these projects will no longer be viable. So just be very careful if you're playing around in this space. Just be aware of the risks. So we'll take a look at a couple of those stocks. Crude oil, West Texas Intermediate crude east a little bit, down about $1 and a few cents. But as opposed to the gold market, energy stocks are leading the way. They're going up faster than the oil price, and they're showing great resilience to a pullback in the oil price as well. We'll take a look at that. So positive signs in that sector. So let's jump in and take a look at a few charts. So these are a few of the more common lithium stocks that people are trading. This is Galaxy Resources. You can see it's been pretty volatile, but we had a really big surge from August last year. The price was under $2, and then it went to $4.40 just recently. People were getting very, very excited about the lithium story, and it's just becoming a bit overheated. You can see the reaction to that announcement. Bang, bang, 2 big losses, and we've gone from $4.40 down to touch $3.40 on Friday. So, that's what can happen when something changes in the sector that's been bid up on a lot of speculation. Let's look at Pilbara Minerals, another one of the real high flyers of the lithium sector. And, the price had gone from 40 cents in September to $1.20. So it had tripled basically in slightly over the 3-month period. You can see the impact of that price decline over the last couple of days. And the last one I want to look at is another stock called Altura Mining. There's heaps of these, so I'm just picking a few. And again, two big falls from around the mid 40 mark, and we got down under 40 cents on Friday. Now these stocks, Pilbara Minerals, I think is expected to reach profitability this year, but the PE will be about 900 on the current forecast, and that's based on the current lithium price. Now, admittedly, that PE will drop to about 11 in 2019 if everything that goes into the forecasting model holds. But if the lithium price comes off, that has a massive effect on profitability. So, that would be a real problem. Altura Mining is forecast on about a 200 PE this year, dropping to around about 10 in 2019. But these stocks under a falling lithium price are under considerable risk, that's for sure. Turning now there's the spot copper chart, so not a lot of change there. So just to wrap it up, the dominant trend remains upwards, no question. Short term, it's well overbought. Just care is needed. And in 2018, we're going to see more volatility. Patience is a really essential ingredient for your activities this year. Have enough stocks that you've got a chance that something's always going to be offering you an opportunity, but be patient enough to wait for those opportunities. I expect in the US most sectors are going to head higher, but we should be looking to exploit the pullbacks, because that's where the risk is lowest and the rewards are the greatest. So why wouldn't you enter at that point? Portfolio analyst this week. Again, I've got a few questions on local resource stocks, and I'm going to be presenting an outstanding US investment. Just one thing I forgot. I meant to look at the US energy sector. So let's just take a look at XLE, which is the overall energy sector. And you can see that it's gone up very, very robustly since the lows down in August. And that performance going from around 62 to 77 significantly outperforms the gains that we've seen in the energy patch. And you'll notice that whilst the oil price did pull back on Thursday and Friday, that there was hardly any dip in the actual indices, the stock indices themselves. So this is quite a different character to what we're seeing in the precious metals market, and that's a sign that this has got some real momentum. So that's it for this week. There's my contact details, and if you haven't partaken of Portfolio Analyst yet, I would strongly suggest you take advantage of the free trial. And I think if nothing else, you'll learn a lot in how to look at the markets. That's it for this week. Cheers.